This is Mitch Kramer and Mike Lanise, and we're presenting the April Guide to the Markets webinar. Hope everyone has had a good
Muted.
all have gotten their vaccine shot. We'll talk a little bit about COVID. It looks like we're kind of at the end of this, so we still need to be careful. We'll share some very good information today about that. Joining me on the call today, I have Mike Lanise and Trey Talley. Tabitha is doing her annual G.I. Jane Reserve Army National Guard work this week, so she couldn't be joining us. So we'll go ahead and get started. First thing I want to share with you is every Monday, or almost every Monday, Mike does a weekly market update. And you can subscribe to it by clicking on your button here, and you can hear what Mike has to say, what's going to be going on in the markets. And a lot of people really enjoyed hearing from Mike. Next thing we'd like to talk about, and I'll turn this over to Mike, is kind of what's been going on in the markets and how it's impacted our portfolio. So Mike, why don't you kind of bring us up to speed?
Thanks, Mitch. Hi, everyone. Okay, well, we see this at the beginning of each of these webinars that we do, and we just want to put things into perspective based on where we started on the last positive day pre-COVID. And if you look at the S&P, there is the white line. It is up during this time period of almost 22%. But I think the red line is a little bit better of a comparison in that it's not skewed by the market cap weighting of the S&P. The S&P, the top 5 stocks are typically your FANG stocks. They have like a 30% weighting on the S&P. So it really skews it, whereas those same companies each have a 1/500th rating on the red line. And so I like to use the more equal weighted to say, hey, this, whether is this a broad market rally or is this a very specific tech rally that we saw as we initially started coming out of COVID. And so there's some the key insights down below that our investors are becoming more optimistic. Federal Chairman Jerome Powell said that we're kind of at an inflection point where you're having the stimulus from the Fed go along with the shots, the vaccines that are happening, and that should create a pretty strong environment going forward for us. Stability of bond yields remains a bit of a concern with the 10-year rate right around the 1.6 mark right now, and we're going to see some continued volatility here probably through the entire year, through the rest of 2021. If you look, where have we been by quarter? So notice on the far left, there's a lot of red over there, except for the bond market, and that was that first quarter where we saw the dip in the marketplace when COVID hit us. And I highlighted a couple of things here in yellow. On the top section there, that's the S&P index, what it did fourth quarter 2020 versus first quarter 2021. And if you look at our stock portfolio and how that compared during those same time periods, and what we had been telling you guys is that we were positioned to come out of COVID. We just didn't know how long it was going to take. So those of you that were patient during that time period are really starting to see some of those returns in your stock portfolios.
And something else, Mike, I would point out that the bond market, and we've been talking to you guys about this for quite a few months, the bonds actually lost money for the first quarter. And we'll show a slide here in a little bit talking about how odd that is when the stock market goes up and the bond market goes down. So the next slide, we're going to talk a little bit about what's going on at a global level and the global economic activity momentum. And this red line here basically indicates the recession, and this is the COVID lockdown that we had through 2020, and various countries handled it differently. I think our country, the United States, we did a really good job, especially compared to Europe and some other countries around the world, and our growth is significantly stronger going forward. So I think it's a credit to the prior administration, and some of the actions the current administration is doing has helped us. Japan is struggling a little bit, and some of the European countries are struggling. China, and anytime you see something coming out of China, there always should be an asterisk, and you really believe it. And people who look at some of the death rates in the crematoriums that were running 24/7 for months. There was a lot more people that died of COVID than the CCP is recognizing. But the bottom line is we're getting out of COVID. We're getting back to more normal. There is pent-up demand, and we'll talk a bit more about that here in a minute. When you look at the overall economy, we were having this V-shaped recovery. We're having a trend growth of about 2.5%. The important part to look on this slide is that our GDP estimate for the first quarter is 4.5%, and it's expected to be more than double of that at 10% and 8% in the third and fourth quarter, and that's a huge number. And just to remind people, most of the GDP in the United States is what we spend as consumers on this call. So 2/3 of our GDP comes from this. Exports have a tendency to be negative for the U.S., and the reason for that is we import more than we export, and that's been a trend that's gone on for a long time. Mike, anything you want to add to this?
Sorry about that. Just that it's going to be 10%. So these are JP Morgan's estimates. They're estimating a 10% GDP in the second quarter, and then falling back to 8% in both the third and fourth quarter, Mitch. All three very, very strong. And I actually might think those might be conservative estimates, Mitch.
Yeah. And I think this is a really interesting chart. And we talked a minute ago about how stocks have started up, but bonds have started down. And we were very hesitant to invest a lot of money into bonds right around the first of the year because of this particular scenario. But what's interesting is the average return for the next 9 months, the bond market turns around. Because normally when interest rates start to rise, the bond prices have the biggest pullback. So the stock market is expected to be good, and the bond market should stabilize for the next 9 months. But what's interesting is this scenario here is, Mike, it's happened only 10 times in about the last 95 years. So it's very unheard of.
Yes, it's 1926. So anyway, it's not saying that this is what will happen, but it's a window of a high probability of what we're looking at for the rest of 2021.
Yeah, and Mike, why don't you talk about this next slide about what stocks are doing well this year and which ones are lagging?
Okay, yeah. So if you guys look at the bottom of this, you see 1-5, 6-20. Right, these are the top 5, 1 through 5 largest stocks in the S&P 500, 6 through 20, 21 through 100, and then your bottom 80%, your 101 through 500. And this is where the returns are coming from so far this year. Well, that 3.8% in your 1 through 5 largest companies, those are your FANG stocks. That's what's been driving the market during the COVID downturn, and we saw those numbers in 2020. But if you look now, you see that it's a much broader rally. By the way, these are all large companies. Your top 500 companies are huge companies in the United States. So don't think that small caps are necessarily driving returns, but that bottom 80% of the S&P 500 shows that it's a broader market rally. All sectors are starting to participate, and the sectors that weren't getting the love prior to the releasing of the lockdown are now starting to feel the love again.
Yeah, and that wasn't the case last year. It was primarily this one top 5 stocks, the FANG stocks, carrying the market for most of all last year until the fourth quarter. So, and this is actually a very good bullish sign, because there is a lot of money entering the market, and even with the government spending its money and providing cash and guarantees, we think regardless of what happens, unless there is some kind of military conflict with China and Taiwan, Ukraine, or Russia, we think the market should be okay for this year. Beyond that, it gets a little bit more murky. So, Mike, why don't you talk a little bit about this second quarter and this great reawakening?
Okay, so bottom left slide. So yellow is the current crisis we're in. Orange or reddish is going to be your great financial crisis of 08, 09. And what you're seeing there on the left-hand side is the financial impact to GDP. And the impact of the current crisis was only 1/4 the hit that we took on GDP during the great financial crisis. And then you look at government stimulus in response to that. The stimulus right now is 4 times as great as it was during the great financial crisis. So 1/4 of the impact gets 4 times the amount of stimulus. You can say that government learned by not stimulating enough during the great financial crisis, but you could also say, you know, we just went into this last stimulus package with $1 trillion in unspent dollars. You could also say it's a bit of a money grab. So it just depends on how you look at it. We're going to have to pay for this, but this is definitely a tailwind for our economy going forward, everyone.
And I think the important point is we talked about this in April, May last year during one of our webinars. I think even in the summer, we talked about training wheels on a bike, where the Federal Reserve and the federal government was going to do what it needed to support our economy until it could take off on its own. The new administration is obviously much more bullish on spending and printing money. So I think that's going to continue. And there's an old adage that says that the Fed's going to give you money, take it, and you don't want to fight the Fed. So I think that's real important. And how we got here is because of what's happened with COVID. And this is the chart that we show on a monthly basis. And this is the first month since January that we're starting to see a little bit of uptick in new cases and 7-day moving average. The deaths are still trending downward, so is hospitalizations. This positivity test rate is perking up, and this is going to be a leading indicator. The number of tests is still declining because I think what you see happening is there's not a lot of people are exposed to people that have COVID. And a lot of this is from the lockdown states in the Northeast and the Midwest, where people have been, shut in and they haven't been exposed to a lot of stuff. Where the states that we have been open, like Texas and Florida, we have much better numbers and our graphs look better. No one knows if we're going to have another peak like this, but the amount of vaccines that are being administered daily, I think when I saw a statistic, Mike and Trey, you can correct me if I'm wrong, but I think it's around 3.5 million. And on the topic of vaccines, some of you on this call may be hesitant about getting a vaccine. I've referenced my youngest brother, Peter, who's a PhD doctor in biotech, and he works for a company that makes drugs. And he has virologists that work for him. So he's very familiar with COVID treatments and the protocols. And he looked at the efficacy of the due diligence that, Pfizer, Moderna, and J&J did. And he said, I asked him 2 weeks ago, and I said, Peter, should I get a shot? He said, Mitch, I'll tell you this. He lives in Austin. He said, if I had to walk to Austin to get a shot, or walk from Austin to Dallas to get a shot, I would. So he got his shot earlier this week. I've delegated that task to my wife to get a shot. So hopefully I'll get mine here in the near future. So
Mitch, that blood clot portion of the shot, my wife got the Johnson & Johnson shot about, I don't know, maybe 6 weeks ago, no issues. But the percentage of blood clots in that shot are 0.00009%. So very, very low risk.
Yes. And the other part of that is on the AstraZeneca, they caught some heat in Europe for blood clots, and they had 16 people that had blood clots out of 3 million doses. And then somebody asked the relevant question, what is the normal blood clot rate, per million people of the same, makeup, and it's 100. So you had 16 on 3 million versus 100 out of a million. It's a normal stat. The statistic should have said AstraZeneca prevents you from getting blood clots. And J&G, as Mike mentioned, has similar numbers. But again, the media has to focus on the negative. But you have Moderna and Pfizer, so it's not like we don't have an alternative. And if you look at what's going on around the world, the United States, as of the end of March, about a quarter of our population has had at least one vaccination dose, and the UK has had about 45%. So we're making good progress. I talked about Texas earlier, and there was a lot of noise in Texas about Greg Abbott opening up Texas. 100% open, no mask. We had, Texas Rangers had opening day with a full ballpark, and they said, oh, Texas is going to have a big spike in cases. And he did this first part of March. You guys can see what the daily cases are. And other states that have opened up have similar numbers. So again, it's kind of hard to trust the science and the media and the politics behind COVID. It's just unfortunate. Now, a lot of people have gotten sick. They've had bad instances. I know people have died from this, so you can't take it lightly. But if you get a vaccine, you can resume more of a normal life. So Mike and Trey, why don't you guys talk a little bit about the raising interest rates and the concern of how that may be kind of a headwind for the markets?
Yeah, thanks, Mitch. So Trey did a nice job kind of going through and putting some facts together about this last cycle of rising rates. And the big concern is, rates are rising. How's that going to hurt the stock market? And so what I'm going to do is just direct your eyes to the bullet points on the slide while I talk about the footnotes. And you see in number 1 there, that's December 16, 2015, the Fed raised rates for the first time since the housing crisis by 25 basis points. So they raised it by 1/4 of a point. And 1 year later, the S&P returned 9.5%. So, okay, there's an instance of a rising rate that didn't hurt markets. Number 2, December 14th, 2016, the Fed again raised rates by 25 basis points and then 3 more times during the next 12 months. And those are those step ups you see up to number 3. And during that time, the market S&P returned over 19%. So again, another rising rate environment where you see that blue line continuing to rise. So number 3, the next rate hike was March 21st, 2018 for 25 basis points. And again, the Fed hiked 3 additional times through 2018. And there you saw the markets take a 6% hit. So the S&P was down 6% in 2018. And then number 4, the last rate hike of the previous cycle. And that was the last rate hike where number 4 is. And by July 31st, 2019, the Fed began loosening policy. And that's when you started seeing the step down with 3 cuts. And in 2019, the S&P returned 29%. So all in, so that last bullet point is in a rising rate environment, the S&P was up about 21%. So we talk about a slide coming up here about when rising rates could start posing a concern, but right now we are not concerned about that hurting the market.
Yeah, thanks, Mike. And this slide here, you guys have seen in the past, and this is the Fed funds rate expectations. And the Federal Open Market Committee, FOMC, which is the Federal Reserve, they have the blue diamonds, and they basically are expecting rates to remain on the bottom until the end of 23. But what we're starting to see happen, the brown diamonds, you're starting to see this pick up a little bit. And this is some inflationary pressure. We talked a little bit about this last month. I think the Fed is being a little too hopeful on the lack of inflation. If you look at gas prices, you guys go to the grocery stores, you're starting to see some inflation creep in. And we got to be careful of that and watch that. But we do see some inflation, but we don't see it being a big headwind to the markets. In this next slide, we'll talk about that specifically. And Mike, if you want to go ahead and tell people what they're looking at here.
Okay, so those little dot plots are where what it says there on the side, rolling 2-year correlation. But that's the effects on the market when you have rising rates. So rising rates moving left to right on your screen, and then that general consensus is that market is moving down. The gray dots, the gray line, that was the 4.5%. So when rates hit 4.5% between 1965 and 2009, that's when that's the point, the inflection
point.
Exactly, yeah. where higher rates start to hurt the markets. Now that has been lowered to about 3.6%. You see there. And I think a lot of that has to do with when you talk about the markets, quote unquote, the markets. A lot of that is your growth stocks. And when you have rising rates, stocks that pay low to no dividend, that are your high flyers, tend to get hit first. So I think that's some of that impact. But we're only at a little over 1.6% on the U.S. Treasury here. So we're not even halfway there yet as to where we would start feeling the concern from this.
Yeah, and just to remind everybody, this is just one factor that could be negative impact on the stock market. There's a lot of other things that could have a negative impact on the market. Geopolitical problems like China going after Taiwan, which I think they would be unwise to do that prior to the 22 Olympics, but after that, who knows? And then what's going on in Ukraine and Russia. But though, anytime you have geopolitical events, and normally a new president is tested the first 6 months they're in office, so there could be something that happens there. So that could be a potential negative. So Mike, why don't you talk about what we're doing in this rising interest rate environment to try to get ahead of it and minimize the impact on our clients' portfolios?
Yeah, thanks, Mitch. So this is JP Morgan. We get a lot of information from JP Morgan. We don't have our own research department. We do our research through other larger companies' research departments. And one of the things that you're looking for solutions in a rising rate environment, and not only JP Morgan, but the general marketplace discusses three main points in a rising rate environment to help offset it. One is going to be investing in value stocks over growth. The second is going to be investing in emerging markets. And finally, taking advantage of alternative assets. And I just want to kind of go through each of those in the next 3 slides. So, and by the way, we are doing all of these things. We were doing all of these things prior to this rising rate environment kicking in. So if you look, first of all, that lower left half of the chart, what this gray line is signifying is when value stocks are cheap in the marketplace and where growth stocks are cheap.
Expensive.
Well, yeah, we are in that bottom section there where it says value is cheap versus growth being expensive. That's the current environment we find ourselves in. And you look for comparison back to the far left there, the dot-com bubble, when you had your high-flying growth stocks pop and your value was where you were going to get your money from. And I just threw a couple of examples out there of what a value stock would be. A little more stable dividend type stocks, your Walmart, Honeywell, Cisco, Visa, and your growth stocks are going to be more of your Amazon, Google, Facebook type names. The second thing that the next thing that's going to help in a rising rate environment is going to be emerging markets. And emerging markets, there's 3 parts to an emerging market that help, and one is going to be accessing higher yields. Emerging markets are considered riskier, so you're going to get higher yields in a rising rate environment. The second thing is going to be improving credit quality in an emerging markets in that rising rate environment, and then finally lower duration risk. And when you think of duration, you think of the longer something is, the riskier it is. So that lower duration risk helps emerging markets. And then, by the way, we did start investing in emerging markets here with the new Biden administration. We were not a fan. Anytime you say emerging markets, you're talking 30 to 40% investment in China. And we were not a fan of China. We thought the Trump administration was hammering them. We think that the Biden administration will be a little more open to China, returning things to normal. And so we went ahead and got back into the emerging markets. And then the final thing is going to be alternative investments. And one of the things that we use as far as alternative investments is calls. We do covered call writing. We agree to sell your shares and we get a fee for that. And the covered call writing, we also have put protection that we put on. We are not currently using put protection, but that is one of the things that will give you additional yields in a rising rate environment. So we are doing all 3 of these things to help offset rising rates. Okay, so for any of you that were on the presentation a month ago, this is a very similar slide to that. Excuse me. I will direct your attention to the second bullet point under corporations, bringing back the alternative minimum tax for corporations earning $2 billion or more. That number was raised to $2 billion. It was $100 million on the last slide. And then the first bullet point under the households, increasing taxes on those households earning more than $400,000 per year. And the impact of that is that 1.5% of households fall under that category, and they pay about 37% of all federal taxes. There's still a little bit of ambiguity between households and individuals, but I think households covers it. So I don't know.
Yeah, I think one of the things that was interesting, a lot of people had talked about, should we buy gold? We heard a lot of this in January and February. And as you guys had seen on the prior slides, bonds had a really bad first quarter, relatively speaking. People understand volatility in the stock market. The bond market, people are a little more sensitive to it. But it was the worst first quarter for gold since 1982. And we had said back in January and February, when you see gold advertised on TV to buy, that is a sell sign. So hopefully you guys sold some gold. But gold may be a good investment at some point, but not now. So let's talk a little bit about as the economy heats back up again. This is a high frequency economic activity. So this shows as the United States opens up. The top two lines here, the purple and the teal blue. This is mortgage applications. A lot of people refinance their houses. You don't do that every month. So of course that's going to tail down. People have been buying a lot more stuff, more confidence. People go out, they have money. So that's increasing. But the remaining four, which is all travel related, you're seeing pretty significant, sizable upticks. I know we were looking at going to Hawaii this summer for vacation, and I wanted to go visit some clients in Arizona. And actually, airline ticket to Phoenix from Dallas was significantly more expensive than Hawaii. So I thought that was just kind of interesting, but supply and demand. I just read something in the Wall Street today that American Airlines expects to be at full capacity this summer, bringing people back and taking planes out of mothballs, which is really a good sign for the travel industry. There are some challenges though, and the challenges, there's a couple of slides I'm going to go through. This one is going to be impacting a lot of the millennials generation, Zers, and kind of the frustration. So there's a lot of information on this slide, so I want to kind of go through and have you guys focus on the ratio of median wealth to income by age group. So if you look at this, 1989 is blue and 2021 is the brown or the dark gray, and this is age group. So people that were 35 to 44, so people that were 35 and 44 in 1989, their income was higher than people the same age group today. Same thing for 45 to 55. 55, 64, it's the same. And people that are older, the older baby boomers or greatest generation, have done better. Why is this important? We have an income gap in this country and an asset gap, and we're becoming like a third world nation in terms of how our income is being generated and kept. And it creates a lot of frustration for people in the middle class. So we have a lot more poor people and a lot of very wealthy people that have lots of power, and they're squelching the middle class. If you look at the ratio of financial assets to GDP, there's been a significant uptick really for the last 4 or 5 years. So people that have money, who have investment assets, have done well, but people who can't save or don't have money, they're really, really struggling. And what that creates is a lot of angst and frustration and anger in this country. And if it's not addressed appropriately, you're going to see potentially some civil unrest potentially, because people just don't like what they're seeing. So it's just something we're keeping our eyes on. And speaking of debt and what we're dealing with, this is a chart we've shown in the past. And if you look at the federal budget, these numbers have been pretty consistent. The difference is this other category, I would call this pork, is now the largest component of how the government spends its money. But what the sad commentary is this part of the slide right here, 50% of what the government spends is borrowed. This used to be 19% not too long ago. And if you look here to the upper right-hand side, the proposed $2.3 trillion infrastructure bill will add to this number here. And they're speculating that the spending will decrease beyond this fiscal year 21 that ends in September. My concern is when you give government spending and they feel like they can spend without recourse, you have a spending problem and it becomes a habit that's not healthy. And that could create some potential problems down the road. So it's just something we're keeping our eyes and ears on. I think the infrastructure bill may have a much more difficult time getting through Congress based on our election. The Democrats only have a 6-person advantage in the House right now, and the Senate's tied. And some of your more moderate senators and House of Representatives may not want to vote for a bill that's got a lot of pork in it. I think there's some good stuff in the infrastructure bill, but there's also a lot of payback for donors who supported the Democratic Party. This is the slide that when you guys start traveling and getting out, this is something you're going to be experiencing. And that's this area right here, leisure and hospitality. What's happened with all this money the government is spending and giving people, it creates a disincentive for people to go to work. Candace and I went to Charleston, South Carolina for Easter, and they had opened up about 2 weeks before. A number of the restaurants we went to and some of the hotels we just walked in, they were struggling to service and help people, and their capacity was reduced. And I said, why is it so empty in here? They said, we can't get enough cooks, waiters to wait on tables or cook the food. And I'm afraid that may be a bigger problem, because if the government's going to pay you not to work, a lot of people will not. And the leisure and travel sectors, they're trying to come back, they can't get enough people to work. And if we go back 12, 15 months ago, the biggest problem people had when they were working, you couldn't find enough qualified people to do the work. We had a shortage of qualified workers. We have 10,000 baby boomers a day turning 65, and that's going to be going on for the next few years. And this is going to continue to be a potential problem. So these jobs are going to come back, but I hear about all these great job productions or job creations that's going to occur. Where are they going to get the people? And the issue on the border, these aren't people that have a skill set. Most of them don't even speak English. So that's the people not going to get the jobs. I guess the people from India and who have college degrees, but it's a lot harder for them to get all their citizenship and their papers. So we do have an immigration problem, and I just don't think what I see happening out of DC right now is showing some very good leadership in responsible behavior. And then we look at the debt, and again, this is a potential problem. You look at this hockey stick jump up for our government. We were around about 100% of debt to GDP, and I've showed slides to many of you in meetings about Japan's debt to GDP is about 260%, and their economy hasn't collapsed. Now, my concern is our politicians, I've said this for years, look at Japan and thinking, 260, we're at 100, we got money to spend. I think this is buying votes. I really think this is buying votes and buying influence, where if you look at us as consumers, we learned our lesson from the spending binge we went on in the housing crisis. We paid down our debts. Corporations are being wise. They look at their marginal cost of capital. They said, well, we can, issue debt or refinance our debt, or issue debt and buy back stock, which is great for short-term earnings numbers, but it's not good for R&D. That's what corporations have done. Mike talked earlier about the duration, and the longer the duration, the more sensitivity bonds are to interest rate movements. So we showed the losses in the first quarter for the bond market. And when rates are low and they start to go up, that's when you have your biggest hit in the bond market. So that's what this is showing here. So these are some potential icebergs further on down the road. We don't think it's going to impact anything today or tomorrow, but it is something we need to be very careful of. JP Morgan is one of the companies that has really embraced climate change, and they have a lot of slides in here about climate change. And this is the one I just wanted to show, because I think there's something that's being missed in the whole climate change discussion. So if you look on this chart on the left right here, China is the olive line, US is gray, and the EU is purple. You can see here in our country, right around 2000 or early aughts, we were high. We've been decreasing it, and so has Europe. But look at China. It is going up like crazy. They love coal-fired plants for their own country, but what's worse, and this isn't included here, they export those coal-fired plants to countries in Africa. So when someone says, climate change, climate change, climate change, your question should be, what are you going to do about China? everyone was so happy that President Biden joined the Paris Accord. Why didn't the media ask him, are you going to make China join the Paris Accord, Joe? No, he's not going to ask that question. And if you look at this line here, and we know how honest China is, do you guys really think China is going to really ratchet down their carbon footprint while the rest of us, Europe and the United States, we will actually make concerted efforts, which I think is outstanding. But it's kind of like you take the if you're in, I use this analogy before, it's like you're in flying in the 70s and the early 80s when you had a smoking section in the back of the plane. If one or two people are smoking, the whole plane's a smoking section. And that's kind of what's going on with climate change. So anybody that talks about it, ask them, say, what are you going to do about China? All right. This chart here just shows how much a traditional portfolio strategy is becoming extinct. And if you have a 60-40 portfolio and 60% is equities, 40% is bonds, and you kind of look at the yield and what it would generate, if you're going back to 85, now you're looking at about a 3.2% yield. So on $1 million, that's about $32,000 a year you can live on. Most people can't afford to do that. And if you have this kind of portfolio like this T-Rex here, it's dead. And you're going to have a lot more money. And what we've done at Fluent, and we've talked about this, is we use options to mitigate risk and generate income. And if you look at a cash situation for people that have a lot of money in cash, really since '08, you haven't had enough income from your cash investments to beat inflation. And then we have a couple of parts over here. We have medical costs and then education costs. So it's become a much more challenging environment for conservative investors. And Mike, Mike talked about this slide here earlier, and this is our solution to the fundamental marketplace problem. How do I turn my portfolio into a paycheck? And the stock income portfolio, we're generating about 1.24% per month. That's $12,400 on $1 million. Advantage is just a little under 10% annually of cash generation. ADV, which is half stocks, half ADV, is just under 5. Growth is about 3.38%. And growth with income and growth with income admissible is just under 3. And stock income is north of 12. So this is the Fluent Financial solution to the marketplace problem. So Mike,
Mitch,
anything you want to add?
Just to put that in comparison, if we looked at that previous slide where you're showing 3.2%, 3.1%, where you're getting $32,000 a year per million. If you have $3 million saved up and you're in the traditional 60-40 portfolio, you're generating $96,000 a year. If you are $3 million in stock income, you're generating $360,000 a year. You're taking on more risk, but not that much more risk. So, we've really hit on something with this this way to take your current investments and just allow you a livable wage off of those investments.
Great. Yeah. Thanks, Mike. This completes our webinar. I'm going to open up the channel for questions. And you guys can type in your little speech balloon, and let me see if we can unmute everybody. Tab normally does this, so I'll try to get everyone unmuted here.
And Mitch, we got a question early on in the seminar. There's talk today that China hopes to replace the dollar status as the world's reserve currency by creating a digital yuan. What happens to dollars and dollar-denominated savings and investments if the U.S. dollar loses its reserve currency status?
Yep. And this is a multiple-part question. We'll go through it. I see the same question, Mike.
Okay, thank you.
Yeah. First of all, to be a reserve currency, one of the things that you have to have is a transparent government and Federal Reserve. Now, we've already talked earlier about China and their opaqueness and their willingness to hide. I think that would be very challenging for China to do that because the world would have to accept China and what they're doing. Now, China believes the means justify the ends, and they have a tendency to use, let's just say, less than professional means of generating influence in people they do business with. So I think that would be very difficult for China to do. The second part is how do dollar savers protect against that possibility? Yeah, you could diversify the US dollars into different currencies. I wouldn't recommend cryptocurrencies because cryptocurrencies have nothing behind them that back them. The cryptocurrencies are a version of the 21st century Ponzi schemes. And speaking of Ponzi schemes, I just read that Bernie Madoff died recently. Do you think China can inflate or dethrone the U.S. dollar? No, I do not. One of the problems that China has that's not reported very often, they have a huge demographic problem that's arguably almost as bad, or if not worse, than Japan. With their one-child policy, even though that went away a number of years ago, culturally it's been ingrained. And one of the most popular vacations before COVID was for China men to go to Thailand, the Philippines, Cambodia to find a wife, because there's not that many Chinese women that are single. So they're having to go overseas, and China, a lot of these Chinese people are not having children. So they are going to they're going to have a significant drop off in people, and there's not going to be as many. Now, granted, they're a much bigger country, 1.4 billion people. We're about 330, but that's going to impact China. But the problem is they're going to have a lot of elderly people who can't work, who can't function, or more importantly, they're taking money out of the system versus putting it in at a much greater rate than we are. And our birth rate's still 2.0. And that means where our population is static. And again, we have immigration coming in, and who knows what those numbers really are. So that's what we see happening. And any other questions? All right. Well, we thank everybody for attending our webinar. We'll have this posted that you guys can listen to it. And we appreciate your support and confidence, and we look forward to speaking to you next month. Have a great evening.
Thanks, everyone. Reach out to us individually if you guys want to take anything offline as far as questions.